So you're about to retire, or perhaps you've retired recently, and you're really nervous about investing in the stock market. How should you handle that fear? Well, this topic came up when I received an email from a viewer recently. He wrote me and he said he's in great shape. He can run a marathon. He's been married to his wife for 40 years. He says, but my financial position, he says he's embarrassed to say, not so good. He says he's scared. He goes, I don't have any debt except the mortgage. That's good. But he says, I have $200,000 in a savings account at 4.5%, and I'm afraid to invest in the market. I can't handle any risk. Very important. Remember that. He can't handle any risk. Would you recommend I learn T-bills, I-bonds, or CD ladders? Any direction would be appreciated. A really important question. I think most retirees, myself included, face that fear. The question is, what do we do with it? And in this video, I want to walk through 8 things to think about as perhaps you deal with your own fear of the stock market. And this could be true even if you're many years away from retirement, but the focus for us is going to be for folks in or near retirement. So, number one, we really have to understand risk. He alluded to this fear of risk in his email. And certainly the stock market is risky in that it's volatile. We all know that. It goes up, it goes down. Sometimes it goes down by a lot. But here's the point. It's not the only risk we face in retirement. And in fact, I would argue there are at least 2 other risks that are more important. What are they? The first is running out of money. That's probably the single biggest risk we have in retirement, at least financially, right? So we could be super focused on the risk of the stock market and perhaps put all our money in what feels like super safe bonds or certificates of deposit, for example. But what if that actually increased our risk of running out of money? At a minimum, we would want to know that as we think through our retirement plan. The second risk, inflation. Even if inflation is relatively modest, think 2 to 3% a year, prices are going to go up significantly over, say, a 30-year retirement, and we have to have a way to deal with that when it comes to how we invest our money. So, yes, the stock market's volatile. Yes, we should consider that risk. But in considering it, we shouldn't ignore those other risks, running out of money or inflation. And that brings me to point 2 in today's video, and that is we need to create a financial roadmap for retirement. And here I want to show you 2 things to think about as we do that. The first is, this has been Bill Bengen's paper. This is the one from 1994 that gave us the 4% rule. And I want to focus on this chart here, figure 2. And what it is, you can see he's assumed 5 different stock bond allocations, 0% all the way to the left, up to 100%. And so in each of these groups of bars, the far left bar here is 0% stocks or 100% bonds. In his case, he was using intermediate term U.S. government bonds. And then these numbers down here are the initial withdrawal rate, 1% up to 8%. And then, of course, whatever that is, it gets adjusted for inflation. And the chart shows us, based on historical data, how long your portfolio would have lasted given your stock bond allocation and your initial withdrawal percent. He stopped at 50 years. So like, for example, at 1%, these would have gone longer than 50 years. In fact, at a 50-50 stock bond allocation, they would have gone in perpetuity. They would have never run out. But what I want to focus on is this bar to the far left. At 1%, yeah, 100% stock portfolio, or excuse me, bond portfolio lasted 50 years based on Bill Bengen's analysis. But even jumping to just 2%, which I think folks would consider quite low, you start to see that 100% bond portfolio runs into some problems. It certainly lasts more than 30 years, but not much longer. And if we go to 3%, still a fairly conservative withdrawal rate, now we're down to around 20 years. And of course, when we go to the traditional 4%, it doesn't even last 20 years. Now, I will stress that these represent the worst case scenarios, right? There could be some retirement periods where a 100% bond portfolio with a 4% withdrawal rate would have lasted longer, but that's sort of the idea, I think, for retirement planning generally, is we want to hope for the best but plan for the worst, right? We don't want to plan for the best and then find ourselves running out of money after 10 or 20 years. And so as we think about dealing with the risk of running out of money, I think we need to consider this kind of analysis. Now, again, your specific situation may be you only need 1% of your investments, and so maybe a 100% bond portfolio might work for you, but at least consider this. Now, the second thing I want to show you is New Retirement, which we've talked about. It's the planning tool that I use. You can model these different scenarios in New Retirement. What I've done is sort of stripped just about everything out of this plan to make it very, very simple. There's just one account. It's at $1 million. It's all in a Roth IRA. And I'm assuming we invest it, in a stock, primarily stocks with some bonds with an optimistic rate of return of 10% and a pessimistic rate of return of 4%. But in the assumptions here, I'm using average returns. And so I don't know how well you can see it, but that means we're assuming a 7% rate of return. And we're assuming expenses of $4,600 a month. And then there's also some Social Security thrown in. And we will look at the overview. This top line assumes we just earn that 7% each and every year through retirement and things look rosy. But of course, we know that's not how it works. And so this bottom line actually uses a Monte Carlo simulation. And it says, it's taking a very, very, very conservative approach to Monte Carlo analysis and saying, I want to assume we have at least a 90% chance of success. So we're only going to consider 10% failure. And our money doesn't last quite 30 years, but pretty close, right? And in fact, we see here an 87% chance of success. So why am I showing you all of this? Well, you can model a different investment approach. We could come to our Roth here and we could say, well, let's do 100% bonds. So what would that rate of return be? Well, I don't know exactly, but let's put a 5% optimistic and a 1% pessimistic. If we save that and go back to our overview, we can see that our chance of success has dropped significantly. Now, again, you could change these assumptions. Maybe your expenses are different. The point that I wanted to make here is that with software like New Retirement, you can model all of this and factor in Medicare, Roth conversions, and 1,000 other different combinations. But you'll see this will give you some idea of what your roadmap might look like depending on how you want to invest your money. It gets us back to those questions of inflation and running out of money. A tool, you don't have to use New Retirement. There are certainly other retirement planners, but these planners can help you figure out, based on how you want to invest your money, what you'll be looking at in terms of possibly running out of money. Of course, you could always hire someone as well to do a financial plan for you. But point number 2 is we need a financial roadmap for retirement. Whether you do it on your own with a tool like New Retirement or you hire someone, you can model these different return scenarios based on how you want to invest your money. All right, number 3, I think this is a good strategy regardless of where you fall into this investing in stocks and retirement, and that is figure out how much of your required expenses will be met through some form of guaranteed income. So for most people, that's going to include Social Security. For some of you, it may include a pension. Perhaps others have purchased an annuity. And the question to answer is, how much of those necessary expenses? So I'm not talking about the trip around the world, but I am talking about housing and food and clothing and some level of comfort in retirement, whatever that is for you. How much of those expenses are covered by guaranteed income? Now, the answer to that may give you great comfort. You may say, Rob, I can live off just Social Security or just Social Security and a pension. That, I think, is a good place to then think about. Maybe you could handle some fear of the stock market, knowing that even if we had bad markets for several years in a row, you're okay because you've got guaranteed income to meet your expenses. On the other hand, maybe your guaranteed income, only meets half of your necessary expenses. Again, this is just something you're going to need to assess, for your own specific circumstances. But for step 3, I think it's really good to understand how much of your guaranteed income is going to cover your necessary expenses. And depending on that answer, we come to the 4th thing I want to share with you, and that is I really like to think about fixed income in terms of how many years of expenses will it cover. Now, if you've watched my channel for a while, I'm not a fan of the bucket strategy. Let's put that aside for a minute because that's not what this is. But what I would do is I would take my guaranteed income and say, okay, it covers, 60% of my necessary expenses. I still need to take out, let's just say, $15,000 a year, whatever it might be for you. Do I have at least 15,000 times 10, $150,000 in some form of fixed income? For me, it's the total bond market fund and a TIPS, intermediate term TIPS fund. But can I cover, along with my guaranteed income, at least 10% or excuse me, 10 years of my necessary expenses. I think for a lot of folks, where you end up with, it turns out, is something near a 60-40 portfolio. Again, that's 60% in stocks. And I get it, you've got that fear of the stock market, but if you can cover all of your necessary expenses from guaranteed income and then your fixed income, very safe fixed income investments, it may help you deal with the fear of the stock market. Again, maybe it doesn't, but this is at least how I think through it. Now, if that's not enough, it brings us to point number 5, and that is you could consider a tips ladder. I just did a video on the tips ladder. You'll find it in the channel. I'll link to it below this video. But tips, as you may know, today you're going to get a real return of about 2 to 2.5%. What that means is you're going to get 2 to 2.5% plus whatever inflation happens to be. So, for example, we go back to our hypothetical where you may need, say, $15,000 a year over and above your guaranteed income. You could create a 30-year tips ladder to cover that $15,000. Again, I covered this in the video that I'll link to below this video, but there's a free tool here that will allow you to create that tips ladder. And we'd put in this case, $15,000 real income. That means after inflation. And it creates this tips ladder. And again, check out the other video. I know this probably looks overwhelming, but you can. It literally tells you the exact tips to buy and how much all the way out. You're going to buy these all at one time, and it's going to give you a tips ladder that lasts 30 years. Again, that might seem overwhelming to some of you. You could always talk to your broker, say a Fidelity or a Schwab or a Vanguard. They would certainly help you do this. Now, I want to stress that a tips ladder is not without risk. You can only build out a tips ladder 30 years. So, if you're in your early 60s and you retire, you might live more than 30 years. And so you have to have a way to deal with what they call longevity risk. But that being said, a combination of guaranteed income like Social Security and perhaps a pension along with a tips ladder may give you the comfort you need to overcome the fear of the stock market. And then assuming that you have money left, perhaps you'd be open to investing in the stock market to help perhaps get even greater returns long term. All right. Now, if a tips ladder isn't enough, or it's perhaps just not your thing, number 6, you could consider an annuity. Now, by annuities, I specifically mean a single premium immediate annuity where you just invest or buy an annuity with a lump sum of money, and you're going to get a guaranteed income for life. And that can go a long way to dealing with the fear of investing perhaps the rest of your money in riskier assets like stocks. The one thing about annuities that you have to keep in mind is that unlike Social Security and unlike a tips ladder, they're not adjusted for inflation. There's no inflation protection with an annuity. So you have to consider that as you think through exactly what might be the best approach for you. In this regard, if you're not comfortable doing the analysis on your own, you could, of course, hire a financial advisor to help you come up with this plan. I would recommend you hire either a fixed fee or hourly advisor to do the plan for you. I wouldn't hire someone who wants to take a large chunk of your assets every year to manage your investments, because that just goes in the opposite direction of what we're trying to achieve. But there are plenty of good hourly and fixed rate financial advisors that will put together a solid financial plan for you. All right, number 7, to the extent that maybe the things we've talked about in this video have got you to the point where maybe you're willing to invest some of your money in the stock market, I would say this: keep in mind, we don't actually invest in the stock market. The stock market is just a place. What we're actually investing in are businesses. The stock market is just a place we go to buy and sell pieces of real live businesses. And I think that mindset is an important one, because the reality is what someone is willing to pay for a given business is going to change over time. And in some cases, people are really excited and optimistic, and they're willing to pay high prices. In some cases, maybe even more than a business is really worth. And in other cases, perhaps we're in a recession or what have you, and they're pessimistic. They're not very optimistic, and they're not willing to pay as much. Those things are going to happen. We know that from history. Sometimes the stock market is very rich in terms of what people are willing to pay, and sometimes it's not. However, keep in mind that we're investing in real life businesses. In this regard, I do think it's a good thing to focus on the dividends that these companies are paying you, even if you own an index fund. Now, I'm not a dividend investor. I focus on total return. But understanding the dividend payments you'll get from the stock investments you have, I think, does two things. One is it sort of re-emphasizes the fact that you're investing in a real business. You're not investing in the stock market. And it can also help you through the difficult stock market times that will inevitably occur, because dividends tend to fall. Sometimes they do, but they're not nearly as volatile as the actual prices of stocks and stock funds. And so focusing on dividends, I think, can help ground us to the reality that we're investing in real businesses. The final thing I'll mention in today's video is this. I think it's a good strategy to actually spend some time imagining the worst case scenario. Come up with your investment plan, your retirement plan, understand your guaranteed income, understand what you're going to invest in fixed income. Maybe you do a tips ladder, maybe you do an annuity, and then say, okay, I've got this other money I might invest in the stock market. What happens if it's all gone? What if the stock market just completely blows up and all that money is gone? How would you survive that? Or more realistically, let's imagine it's down 10, 20, 30%, perhaps several years in a row. That certainly has happened in the past, and it can happen again. What would you do? Do you have home equity that you could tap, either through a reverse mortgage or perhaps downsizing? Again, those might not be the things that you want to do, but again, if we're imagining worst case scenario, what would you do to survive? And I think spending a little bit of time, it's not a negative thought, I don't think. I think it's just planning. If we think about those sort of worst case scenarios, we might come out at the end of that saying, you know, I hope that doesn't happen, but I could handle it if it does. And that might just give you the courage to invest at least some of your money in stocks, even in retirement. At the end of the day, if we think about a traditional 30-year retirement, when we retire in our 60s, we're still long-term investors. And for our money not to run out before our lives do, and to deal with inflation, I think most retirees need some amount of their portfolio in stocks. Hopefully this video has given you some things to think about as you deal with the inevitable fear of the stock market that I think a lot of retirees just understandably have. Well, there you go. If you have any questions or comments, leave them in the comments below this video. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.